This LOS is calculate and compare the money-weighted and time-weighted rates of return of a portfolio and evaluate the performance of portfolios based on these measures. Money-weighted rate of return. The money-weighted return accounts for the money invested and provides the investor with information on the return she earns on her actual investment. The money-weighted return and its calculation are similar to the internal rate of return and the yield to maturity. Just like the internal rate of return, amounts invested are cash outflows from the investor's perspective, and amounts returned or withdrawn by the investor, or the money that remains at the end of the investment cycle, is a cash inflow for the investor. So the important one to see is the money that remains at the end of the investment cycle. When we do our calculations, we're going to calculate that as a cash inflow. I have a study tip here. For the money-weighted rate of returns, the big challenge is looking at the data that is presented to you. Sometimes you can have a question where the data is very summarized, and so it's very easy to see what you need to do your calculations. And other times, especially as you head towards CFA Level 2, there's a lot more data, and you have to be very quick at sifting through and saying what data do I need and what data do I not need. So for this one, for the money-weighted rate of returns, I'm going to show a couple of examples where a lot of data is given and showing you that you need to really zoom in and select the data that you need for your calculations. So yeah, more data is likely presented to you. Speed is a skill. Skill gets rewarded, and this is one area you need to look at the data and be quick. So the next example shows that if the balance at the end of year 5 is given, then solving the questions using the IRR functionality is easy and quick. But in the next question, the practice question, the balances are not given, and you need to work through all the calculations quickly. So this is an interesting question area. Speed is a skill. Skill gets rewarded. So there's speed and skill of looking at data and knowing what you need, and there's speed and skill on the calculator if sometimes there's a lot of small sub-calculations that you need to make. Okay, this is not a multiple choice question, but I just want to work you through an example of the money-weighted rate of return, which uses the IRR functionality on the calculator. Okay, so here's a table. You can see here's the balance from the previous year. So starting at the beginning of time 0, there's nothing. A new investment by the investor, so that's always going to be a negative cash flow. And then we have the balance at the beginning of the year, investment return for the year, the investment gain or loss, withdrawals by the investor at the end of the year, so that's an outflow from the investment, which is an inflow to the investor. So you can see that's negative 350 from the investment, but we account for that as a positive because, as we said, cash flow out of our pocket into investment we treat as a negative, and cash flows back into our pocket we treat as a positive. So finally we work our way through the table and we get to the balance at the end of the year. So this was the key point from the first slide, is that you can see that balance at the end of the year, that's treated as a cash inflow, okay? So I'm just going to bring up our calculator here and just work through this question fairly quickly. So it's a cash flow. Remember, what do? We do second, and we're going to clear our work because we want everything out of the cash flow register. So it's 100 was a negative, CFO 0, enter, arrow down. C1 was 950, that's here. It's going to be another investment into the fund by us, so it's negative 950 plus or minus key, hit enter, arrow down. Remember, frequency is only once. So our second cash flow, that's 350 back to us. That's a positive. So 350 positive, we're going to hit enter, arrow down, frequency 1, cash flow 3. That's so there's no outflow again. So as we said, this balance at the end of the year, we have to use that as a positive cash flow to us. So that's a 1270, and we're going to hit enter, okay? Arrow down, that's it. Just check everything's 0. And then we're going to hit to the IRR key, and we're going to hit compute, and it's 26.10875. Fantastic. Okay, here's just another example. We won't go through it all, but I just want to show you again, if they give you a table in a long format like that, you can see there was a lot of numbers that we didn't need. I circled in squared in green up here the numbers that you needed to solve the question. That becomes fairly typical. So there's another one here below. You can pause the video and work through that one on your own time. Okay, here's an example of a question that if it was on the CFA Level 1 exam, it's definitely going to take you longer than 90 seconds. So it's an investor's transactions in a mutual fund, and the returns over a 4-year period are provided in the table. So we have the new investment at the beginning of the year. That's cash flow out of our pocket. We have the return, and then we have the withdrawals. This is money back into our pocket. So we have some of the cash flows. But you can see what's missing here. We don't have the value of the fund at the end of the 4-year period. So that means we're going to have to work through that entire table. So based on these data, the money-weighted return or internal rate of return is closest to A, 2.15%, B, 3.96%, or C, 7.5%. So let's just go to the next slide and we'll see how we solve that. Okay, this has the table written out in full detail. Of course, if you're doing this on the exam, you would take some shortcuts. But definitely the starting balance is 0. You make a new investment at the beginning of the year, $2,500. And then we had that negative 20% return. So that would have been a loss of $500. There was no withdrawals at the end of the first year. So we had a balance at the end of year of $2,000. And that becomes our balance at the beginning of year 2. And we're going to add another investment, $1,500. So we have $3,500 as our balance, big 65% return, investment gain of $2,275. But we took a withdrawal out, so we have the balance at the end of the year. The balance at the end of the year becomes the beginning of the year 3 balance, and another investment of $1,000. So we get to $6,275. But I've linked these two in gold color to show you that when you do the CF2 here, it's going to be the 500 withdrawal at the end of the year 2, and the negative 1,000 investment at the beginning of year 3. So it becomes, you net the two because there's a withdrawal at the end of the year and then a new investment at the beginning of the year. So you can net the two for the CF3. That's an important thing, okay? And then CF3 becomes the negative 500. But this was the issue with this problem, is that we didn't have the balance at the end of year 4. And so we have to kind of work through the whole table with our gains and losses and our additions and our withdrawals to get that number so that we can input the CF4. Once we've got that, then we're just using the IRR cash flow functionality on the calculator. CF0, negative 2,500. CF1, negative 1,500. CF2, as I told you, those are combined for a negative 500. CF3, 500 back to us. And CF4, as I said, you had to go through the whole table, 4,268. If you calculate the IRR, it's going to be closest to B, so the answer was B. Now don't get discouraged by that last practice problem, folks, because as I said on the CFA exam, sometimes there's some questions where you got to do a lot of calculations, a lot of sub-calculations. It's going to take you more than 90 seconds. A lot of data is thrown at you. Other times, it's testing you on the same learning outcome statement, but it's a lot easier. So here's an example. You buy a stock, 1 share, for $85. Exactly 1 year later, they pay a dividend of $2 per share. That's followed by 2 more annual dividends of $2.25 and $2.75 in successive years. Upon receiving the third dividend, you sell the shares for $100. So what is the money-weighted rate of return? So you can see in this case, the cash flow is a lot easier. Is it A, 7.97%, B, 8.15%, or C, 8.63%? Okay, so this question was also testing on the money-weighted rate of return, but it was much simpler. So again, we're going to use that cash flow functionality on the calculator. Second, we're going to clear our work. So we purchased 1 share of stock for 85. So CF0 is clearly 85. Hit the negative key because it's out of our pocket. Hit enter. Arrow down. We're going to receive a dividend of $2 per share. So that's our CF1. Hit enter. Arrow down. Then we received a dividend for $2.25. We got to go through the frequency first. So C2, that's that second dividend of $2.25. So 2.25. and we're going to hit enter. And then there's a third dividend, $275, but we're also going to sell the shares for $100. So our last cash flow is the $100 plus the $275 dividend. So arrow down through the frequency on the second cash flow. C3 is going to be 102.75. We're going to hit enter. We're going to hit the IR key. We're going to hit compute, 8.15. So B is correct. So you can see that one very quick, less than 90 seconds on the calculator, very easy. Now we're moving on from the money-weighted return to the time-weighted rate of return. So an investment measure that is not sensitive to the additions and withdrawals of funds is the time-weighted rate of return. In the investment management industry, the time-weighted rate of return is the preferred performance measure. The time-weighted rate of return measures the compound rate of growth of $1 initially invested in the portfolio over a stated measurement period. In contrast to the money-weighted rate of return, the time-weighted rate of return is not affected by cash withdrawals or additions to the portfolio. The term time-weighted return refers to the fact that the returns are averaged over time. To compute an exact time-weighted rate of return on a portfolio, take the following 3 steps. Number 1, price the portfolio immediately prior to any significant addition or withdrawals of funds. Break the overall evaluation period into sub-periods based on the dates of cash flow inflows and outflows. Calculate the holding period return on the portfolio for each sub-period. Then you're going to link or compound the holding period returns to obtain an annual rate of return for the year. The time-weighted, and that's the time-weighted rate of return for the year. If the investment is for more than 1 year, take the geometric mean of the annual returns to obtain the time-weighted rate of return over that measurement period. Okay, this is another area where there's a flash forward from the quant section to the portfolio management reading because it comes up again, geometric mean returns. Because of the effect of compounding, the geometric mean return is always less than or equal to the arithmetic mean return, unless there's no variation returns, in which case they're equal. So a geometric mean return provides a more accurate representation of the growth in portfolio value over a given time period than does the arithmetic mean return. And we'll go through an example to show you that. So here I've just included the formula for when the returns are annual, how to calculate the geometric mean. And when returns are, say, quarterly, we obtain the annual return for the year by linking the quarterly holding period returns by compounding them. And we've seen that already in a previous LOS. So this is just a little example to highlight the importance of the geometric mean return. So when we look at historical returns on investments, we always want to use the geometric averages, and this will show you why. So in this example, we started with US dollars 10,000, and we had the following returns for 4 years: plus 10% year 1, minus 25% year 2, plus 21% year 3, and plus 6% in year 4. The arithmetic average would be the 3%, which is the sum of returns divided by the count of returns. If we use that 3% and calculated how much money we had at the end of the year, just at the end of the 4 years, just using averages, a simple way would be 10,000 times 1.03 times 1.03 times 1.03 times 1.03, and we'd get a total of $11,255.08. But that's not what our actual balance would be, and that's why we do not use an arithmetic average to look at investment returns. So let's do the math again. We have $10,000, and at the end of year 1, it grew by 10% return, so we hit $11,000. Then we had a negative return of 25%, so 11,000 times negative 25%, we'd have 8,250 at the end of year 2. 8,250 times 21%, we'd have 9,982.5 at the end of year 3. And then finally, that 9,982.5 times 6%, that return in year 4, we'd have a closing balance of 10,581.45. You can see that's a lot different than the 11,255 that we used if we used a simple arithmetic return to calculate what the balance in our account would be at the end of the 4 years. So this slide just takes you through the math again, but we're going to use the geometric average. So you can see the geometric average, we had the four returns, 10%, negative 25%, 21%, and 6%. And you can see that here. So using the geometric average, it's 1 plus return 1 times 1 plus return 2, which was a negative, times 1 plus return 3, times 1 plus return 4, to the power of 1 over 4, right? Because we know this is the formula that's written sometimes, the square root to the n, which is same to the power of 1 over n, okay? So if we just continuing on with the math, that would be 1.1 times 0.75 times 1.21 times 1.06. Y to the x, 0.25 minus 1 times 100. We get a geometric return, which is less than the arithmetic return because we have it a negative return of 1.42296%. So if we use that and the same way, you know, the simple way, the 10,000 times 1.01 42296, and we did that 4 times, then we would get the correct balance in our account, that 10,581.45. So using the geometric return adjusts for the fact that after a negative year, there's less balance in the account on which to apply the following year's returns. It's important to not use the arithmetic averages when looking at average annual investment rates of return. Okay, here's a nice little example on the time-weighted rate of return, but we've given some data on a quarterly basis, okay? So again, a fair bit of data thrown at you, but I circled in the green box exactly what you need to do the calculations. So you can see we had an amount invested for the quarter and the ending value. So ending minus beginning divided by beginning gives us a holding period return for Q1. Then we look at Q2, ending minus beginning divided by beginning, holding period return for Q2. Q3, ending minus beginning divided by beginning, holding period return Q3. And finally for Q4, we have a holding period return. So recall, how do we do the time-weighted rate of return when we have 4 quarters? Then what we do is we compound the returns. So it's 1 plus return 1 times 1 plus return 2 times 1 plus return 3 times 1 plus return 4 minus 1. So 1.2 times 1.05 times 1.12 times 0.89 minus 1. And that gives us a time-weighted rate of return of 25.597%. So we're down to the last slide for this LOS, and it's just a practice question on the time-weighted rate of return. So an analyst gathers the following information in millions about the performance of the portfolio. You've got 4 quarters. You've got the value at the beginning of the quarter prior to inflow or outflow. You've got the cash inflow or outflow at the beginning of the quarter, and then the value at the end. So the annual time-weighted rate of return is closest to A, 8%, B, 27%, or C, 32%. Okay, this question was pretty easy, folks. Just the one thing that we had to do is that we had the value at the beginning of the quarter, and then if there was a inflow to the fund, we had to add that, and then we had to calculate, because it was quarterly, we had to do again, just same as we saw in the previous slide, ending minus beginning divided by the beginning is going to give us our holding period return for each quarter, and then we were going to compound those returns and calculate what our time-weighted rate of return. So if I just bring up the calculator here, we can see it's quite easy. We're going to do ending 2.4 minus, we can see 2.2 divided by 2.2, and that's going to be a 9% return, okay? Or an easier way to do it, you can just do 2.4 divided by 2.2, and that's going to give you your 1.09. And that's the number that you need here for your compounding, 1.09. So that's a little calculator trick for you guys. You know, speed is a skill, skill gets rewarded. So you can see here it's going to be 2.6 divided by 2.8. So that's ending divided by the beginning. 2.6 divided by 2.8 is going to give us 0.92. So again, I can just use that. I can write that right away. Okay. So for the next one, it's going to be 3.2 divided by 2.4, because we had 2.6, but we took some money out of the fund, so we had 2.4. So that's going to be 3.2 divided by 2.4, and that's going to give us 1.3333. And then finally the last one, 4.1 divided by 4.2. So that's going to be 4.1 ending divided by 4.2 at the beginning, 0.97619. This has just been a little bit rounded. And then, as we know, we're just going to multiply them. 1.0909 multiplied by 0.9286 times 1.333 times 0.9762. Going to hit equals minus 1. And if we want, we're going to multiply by 100. And we can see the correct answer was C. It's closest to 32%. So not bad on the time-weighted rate of return. That question was pretty easy. That's the last slide for this LOS. Thank you.